Hi, and welcome to session 2 with regards to mortgages. Let's talk about the different types of mortgages you have out there that you have available for you to consider, some of the considerations that you have to make when deciding what type and how. There's a couple of terms we should review first off, and those two are amortization and term. So amortization is really about the length of the total time it's going to take you to pay back the mortgage. And in previous times, we've seen that go as high as 35 years. More commonly now we're seeing it in the 25 years that they're going to use those calculations. And then also your 30 years sometimes, depending on the situation. So within the amortization, you have your terms, and those are the terms are, did I do it for 5 years? That's a very, very common thing for people to do, is do a 5-year term. Sometimes it's a 3-year term. When you're in periods of uncertainty around interest rates, a lot of times people are choosing to do shorter terms, hoping that maybe interest rates will come down, or if they know interest rates are super low at a period of time, they may extend the term to take advantage of lower rates as much as possible. So when it comes to the types of mortgages you have, there's kind of two, variable and fixed. So let's talk about the fixed first. So the fixed one, it's that term product, and we're basically saying over the next 5 years, here's the interest rate you will pay based on how these compounding periods, etc. And so what that means is if you have a $100,000 mortgage and we're going to pay it back over 30 years or 25 years, and we're going to do 5 years of that now, what does that payment look like? And so they're going to show you an interest rate, they're going to show you what your payment will be, including interest, and how that will affect you over time. It might be a bit shocking if this is the first time you've done it to realize that depending on the rate, how much you actually pay down in principal versus interest can be low and interest quite high. So it can be kind of disconcerting. So it really does behoove you to check things like what are the amortization, and not to get caught up too much, I guess, in the rate, because sometimes the rate could be higher, but the amortization schedule or the way that they compound the interest is in your favor, so you actually pay less in interest. So to me, the two important things that you have to figure out is how long will it take me to pay this off, and how much total interest will I pay? And those become the barometers of the type of mortgage you want to be in and how to evaluate them against each other so that you can see exactly that rate doesn't really matter as long as you can figure out which one of these is better for you. So with the variable rate mortgage, what they're basically saying is typically they're going to price that as a function of the prime rate. And so prime rate it's the bank rate, so it's what is prime to your particular financial institution, and depending on where they're at, they'll do a plus or a minus on that. And so that means that when rates go up, so does the interest on your mortgage, and they may adjust your principal payment as well. Like, there's a bunch of things you're going to want to make sure you understand if you choose variable. Variable rates can be very attractive in certain periods, especially if you think interest rates are going to go down, because then you're not locked in. So you can actually go down as the interest rates go down. So that's really important. When you comes to choosing which type of mortgage to look at, it helps to have those comparisons done, which kind of leads to who should I work with? Like in the past, traditionally, everyone worked with their banks, and the bank basically gave them an offer, and that was, you took it or leave it. But now there's more and more in mortgage brokers. And so mortgage brokers are typically means that they have access to a whole bunch of different lenders. So depending on your situation, what type of home you're buying, where are you buying that home, they may be able to find a lender that looks more favorably on that type of a purchase. And that allows you to maybe get a better deal because of that. So a broker can give you that broader market segment, and they're very accepted these days, should be able to help you find the best deal for you. They are paid by the financial institution that they place the money with, the mortgage with, so that way it gives you an idea of how they are paid. You're not going to write a check for them on their possible. If you don't fit into a really certain box, especially if you're self-employed or you have commission income or something like that, you may find working with a broker who has access to not only the A lenders, but maybe alternative lenders who will look more favorably upon you being self-employed and that you're self-declaring your income, things like that. It's really important to know where you want to fit for that pieces, and that can really help you decide where to go.